Disclaimer: this content is for educational purposes only and should not be considered personalized investment advice. Green hydrogen investments carry significant risks, including high volatility, technological uncertainty, and potential for total loss. Always consult with qualified financial advisors before making investment decisions. Green hydrogen has become one of the most talked about investment opportunities in the clean energy sector, with governments pledging hundreds of billions in support and major corporations making massive commitments. But underneath all the excitement and ambitious projections lies a fundamental question that every potential investor needs to answer. Is now the right time to put money into green hydrogen, or should you wait for the technology and markets to mature further? The answer isn't straightforward, and it depends entirely on your risk tolerance, investment timeline, and understanding of both the enormous potential and significant challenges facing this emerging industry. Let's start with why green hydrogen has captured so much attention from investors and policymakers alike. Unlike conventional hydrogen production, which relies on fossil fuels and produces significant carbon emissions, green hydrogen is created by using renewable electricity to split water molecules through electrolysis. The result is pure hydrogen fuel with zero direct carbon emissions, making it potentially crucial for decarbonizing industries that can't easily electrify, such as steel production, shipping, aviation, and long-haul trucking. The International Energy Agency estimates that hydrogen demand could increase sixfold by 2050 if the world meets its climate goals, representing a market opportunity worth trillions of dollars. The investment case for green hydrogen rests on several compelling fundamentals. First, production costs are falling rapidly as renewable electricity becomes cheaper and electrolyzer technology improves. In 2020, green hydrogen cost around $5 to $6 per kilogram to produce. Today, that figure has dropped to $3 to $4 per kilogram in many regions, and some analysts predict it could reach $1 to $2 per kilogram by 2030 in areas with abundant cheap renewable energy. That cost reduction trajectory could make green hydrogen competitive with fossil fuel alternatives across multiple applications within this decade. Second, policy support is unprecedented and growing. The United States has allocated $8 billion for regional hydrogen hubs through the Infrastructure Investment and Jobs Act, plus production tax credits worth up to $3 per kilogram through the Inflation Reduction Act. The European Union has committed over $200 billion to hydrogen development as part of its Green Deal. Japan is spending $3.4 billion annually on hydrogen initiatives. China is targeting 200,000 tons of green hydrogen production capacity by 2025. This level of coordinated government support suggests that hydrogen development will continue even if private investment fluctuates. Third, corporate demand is materializing faster than many expected. Steel companies like ArcelorMittal and ThyssenKrupp are building hydrogen-based production facilities. Shipping giants like Maersk are ordering vessels designed to run on hydrogen-derived fuels. Chemical companies are planning to replace fossil fuel-based hydrogen with green alternatives. Airlines are investing in hydrogen aircraft development. This isn't just pilot projects anymore, these are commercial-scale commitments representing billions in future demand. However, the investment risks are equally significant and often underestimated by enthusiastic proponents. The technology challenges remain formidable, particularly around cost, efficiency, and scale. Current electrolyzers operate at 60 to 80% efficiency, meaning 20 to 40% of input electricity is lost as heat. While this is improving, it still means green hydrogen requires about 50 to 55 kilowatt-hours of electricity to produce 1 kilogram of hydrogen. With electricity representing 70 to 80% of production costs, even small efficiency improvements can dramatically impact economics. Infrastructure development is another major hurdle that could delay widespread adoption and impact investment returns. Hydrogen requires completely different infrastructure than natural gas or electricity. It needs specialized pipelines, compression equipment, storage tanks, and transport vessels. The existing natural gas infrastructure can be adapted for hydrogen in some cases, but it requires significant modifications and safety upgrades. Building this infrastructure will require hundreds of billions in investment and could take decades to complete comprehensively. Storage and transport present ongoing technical and economic challenges. Hydrogen has very low energy density by volume, requiring either high-pressure compression or cryogenic cooling to store efficiently. Both approaches are energy-intensive and expensive. Long-distance transport is particularly challenging, with most current solutions involving conversion to ammonia or other hydrogen carriers, which adds cost and complexity. These logistical challenges could limit market development and impact the economics of hydrogen projects. Market competition is intensifying rapidly, which could impact investment returns. Battery technology continues improving and becoming cheaper, potentially limiting hydrogen's role in some applications like short-haul transport and grid storage. Direct electrification is often more efficient than hydrogen for many uses, which could constrain demand growth. Meanwhile, other alternative fuels like sustainable aviation fuels and synthetic diesels are competing for the same decarbonization applications that hydrogen targets. From a practical investment perspective, the green hydrogen sector spans multiple types of opportunities, each with different risk-reward profiles. Equipment manufacturers like Nel Hydrogen, ITM Power, and Plug Power represent direct plays on electrolyzer demand but face intense competition and margin pressure. Utility companies developing large-scale hydrogen projects offer more stable returns but slower growth. Oil and gas companies transitioning to hydrogen provide exposure to the theme while maintaining current cash flows but may face execution risks in unfamiliar territory. The investment timeline significantly affects the risk-reward calculation. Early-stage investors who got into hydrogen stocks in 2020 to 2021 have experienced extreme volatility, with many companies seeing their valuations collapse 70 to 80% from peak levels despite continued fundamental progress in the industry. This reflects the gap between long-term potential and current commercial reality. Companies that looked promising on paper have struggled with execution, cost overruns, and delayed project timelines. Geographic factors also matter enormously for hydrogen investments. Regions with abundant cheap renewable energy and supportive policies will likely see the fastest development and best investment returns. Australia, Chile, the Middle East, and parts of the United States have natural advantages in renewable energy costs. European countries have strong policy support but higher energy costs. Asian markets offer large potential demand but face resource constraints. Understanding these regional dynamics is crucial for evaluating specific investment opportunities. The competitive landscape is evolving rapidly as traditional energy companies, industrial conglomerates, and pure-play startups all compete for market share. Established companies like Air Liquide, Linde, and Shell bring financial resources and industrial expertise but may be slower to innovate. Startups offer potentially disruptive technologies but face funding and scaling challenges. Chinese companies are aggressively pursuing market share with government backing, potentially disrupting global pricing and market dynamics. For individual investors, the sector's volatility and complexity make direct stock picking particularly challenging. Many hydrogen companies are still pre-revenue or in early commercial stages, making traditional valuation metrics less useful. Technical developments, regulatory changes, and project announcements can cause dramatic stock price swings. Even experienced energy investors struggle to evaluate the long-term prospects of specific technologies and companies in this rapidly evolving sector. Exchange-traded funds focused on hydrogen and clean energy offer broader exposure but still carry significant risks. These funds often have high fees, concentrated holdings, and exposure to speculative stocks. They may also include companies with only tangential hydrogen exposure, diluting the investment thesis. However, they do provide diversification and professional management that individual investors might find valuable. The timing question ultimately depends on your investment goals and risk tolerance. If you're looking for steady returns and can't tolerate high volatility, waiting for the industry to mature further probably makes sense. Current valuations may seem attractive after recent declines, but further drops are possible as the market continues sorting out winners and losers. Many promising companies may not survive the transition from pilot projects to commercial scale. However, if you have a long investment horizon and can tolerate significant volatility, there are compelling reasons to consider green hydrogen investments now. The technology is advancing rapidly, policy support is strong, and early commercial projects are beginning to prove viability. Getting in before the market reaches maturity could provide substantial returns for successful companies and projects. The key is careful due diligence, diversification, and position sizing appropriate to the risks involved. For those who decide to invest, focusing on companies with strong balance sheets, experienced management teams, and clear paths to profitability makes sense. Look for businesses with actual revenue from hydrogen activities rather than just development projects. Pay attention to partnerships with established industrial customers and government backing for specific projects. Be wary of companies making grand claims without demonstrated commercial traction. The macro environment also affects timing considerations. Rising interest rates increase the cost of capital for capital-intensive hydrogen projects and make growth stocks less attractive relative to bonds. Economic uncertainty could delay industrial investments in new technologies. However, energy security concerns and climate commitments provide ongoing support for clean energy investments even during economic downturns. Looking ahead, several catalysts could accelerate or delay the investment timeline. Breakthrough improvements in electrolyzer efficiency or costs could dramatically improve project economics. Major industrial hydrogen projects reaching commercial operation successfully could prove the business model and attract more investment. Conversely, high-profile project failures or slower than expected cost reductions could dampen investor enthusiasm and delay market development. The green hydrogen investment decision ultimately comes down to balancing enormous long-term potential against significant near-term risks and uncertainties. The technology and markets are advancing rapidly, but commercial viability at scale remains unproven for many applications. Policy support provides a foundation, but sustained political commitment across multiple election cycles is uncertain. Early investors may capture the biggest returns, but they also face the highest probability of losses from picking wrong companies or technologies. For most investors, a measured approach probably makes the most sense: small initial positions in diversified hydrogen investments, with plans to increase exposure as the industry demonstrates commercial success and volatility decreases. This allows participation in potential upside while limiting downside risk from what remains a highly speculative sector. Whether you invest now or wait, understanding both the potential and the pitfalls of green hydrogen will be essential for making informed decisions in what could become one of the most important investment themes of the next decade.